You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
This is Mining Stock Education, and I'm your host, Bill Powers. Thank you for tuning in again today. We're going to be touching base and getting our update from Dave Kranzler of Investment Research Dynamics. Dave also runs a precious metals and mining fund. He's the editor of the Mining Stock Journal and the co-producer of the Mining Stock Daily podcast. Dave, thank you for coming on the show again. It's great to touch base with you. Let's start by getting your perspective on the gold-silver ratio. I've come across some ideas where some commentators have said if you're expecting silver to really outperform gold to a large degree, you might be disappointed. How would you engage that idea?
Well, first of all, I'd like to say thanks for having me on again. Always enjoy doing this podcast, and especially talking about junior mining stocks and just the industry in general. I think the argument behind the relative performance of silver versus gold is a lot of people, when they're assessing the potential going forward for silver versus gold, look at the gold silver ratio, and over extremely long periods of time, it kind of has been around, averaged out around 16, or it's always at some point in time touched down at 16, at least in the modern era. I mean, if you go back to Roman times, they set the gold silver ratio at 8-1, and that's because it was essentially aligned with the amount of silver in terms of ounces, or how, whatever measurement they were using. It was basically an 8-1 ratio of silver versus gold being mined back then. And it's interesting because if you look at really long-term charts, and you can find them on, using Google on the internet. And one of the things that I happened to notice when I first started getting into the sector pretty much 20 years ago, and was really doing a lot of background research and just trying to get as educated about all aspects as I could, is that if you track the gold-silver ratio through the various eras, especially if you look at it like post-Civil War era in this country, the gold-silver ratio starts to slowly rise and gravitate away from kind of the mid-teens. It bounces around over hundreds and hundreds of years, but it starts to kind of gravitate higher starting in the late 1800s, and the same thing with the Dow gold ratio, which for the first, call it 100 years, 150 years of this country's formation, the gold-silver ratio was pretty close to 1-1. The Dow silver ratio. And then it starts to slowly move higher in the late 1800s. And what I found interesting about that is if you kind of study the history of the gold backing of the gold as the currency, as the actual currency, and sort of dollars as representative, being dollars were issued against gold so that you could fractionalize it and use it make it easier for commerce. Well, you can actually tie the beginning of the dislocation or the unbacking of gold from the dollar to President Lincoln's administration, because what happened was his administration passed a law that allowed people to settle debts with government bonds rather than gold and silver, or gold and silver certificates, which is really what the currency was gold and silver certificates. And the law went all the way up to the Supreme Court when Ulysses Grant was president, and the Supreme Court upheld it. And so that actually started the unbacking of the dollar from gold and silver. So, and then when the Fed was formed in 1913, you start to see the Dow gold ratio go higher, and also the gold silver ratio. I think it was, I think in the crash of 29, the Dow gold ratio reverted back to 1-1. And I think, again, if memory serves me right, the gold silver ratio got down to 16 or maybe a little lower. And then it started to move higher again. And again, as you're moving through, FDR's administration, Truman's administration, Bretton Woods, the dollar becomes less and less backed by gold. And those ratios gravitate higher, right? So now in 1980, when gold peaked, you basically had a 1-to-1 Dow gold ratio briefly, and the gold silver ratio got down to 16 briefly. And now we're in the era of just pure fiat currency. So what I would argue in terms of whether or not we'll ever see a gold silver ratio that goes under 20 will largely depend on whether or not, when there's an eventual global monetary reset, and there will be eventually. No one can tell you when it'll happen. Alistair McLeod has written some articles, and he thinks it's possible it could happen by the end of this year. I'm not going to disagree with him. I mean, I would have thought it would have already happened already. It's impossible to put a time frame on when that'll happen. But when gold and silver are eventually reincorporated into the global monetary system, we'll definitely see the gold-silver ratio will definitely gravitate towards its long-term historical mean. I'm not talking about the last 50 years. The last 50 years where this country was essentially a de facto fiat currency monetary system, the dollar. I'm talking about the last 500 or 5,000 years. And that's what you need to look at, because, over longer periods of time, the world has been on a gold standard for most of that time. So when we do see the ultimate collapse of fiat currencies and the remonetization of gold and silver, I think you're going to see the gold silver, because they're going to have to incorporate silver into the monetary system also, just because they'd have to reset the price of gold at too high a level in order for, just because of just the growth of countries and populations. So I do think that we're going to start to see, we've already seen the gold silver ratio peak. It peaked at 130, 135, whatever it was. And now it's under 100. So, and I think it's going to continue moving lower, and silver is going to outperform gold, and it's not going to happen every day. It's going to be volatile. And ultimately, I think that mining companies that have a blend of gold and silver, or, pure primary silver mining companies, which there's not a lot of them left anymore, are going to outperform companies that primarily produce gold, or companies that are primarily exploring for gold deposits. So that's kind of my take on the situation. I guess that's a long way of saying I disagree with the view out there that the gold silver ratio has reached a structural higher plateau. I think eventually we're going to see a much lower gold silver ratio, and I think it ultimately will go below where it bottomed out back in 2011, which was the low 30s.
Thank you for that commentary, Dave. And I think a key difference is that, as you said, you see silver as its monetary role, whereas a lot of the people that I've listened to that don't see the reversion to historical means in a bull market for the silver and gold ratio, they're focusing more on silver as an industrial metal and basically don't give it any economic qualities. And like you said, if it has a role in the upcoming economic system, it's got to be revalued.
So, I mean, it's poor man's gold. If you're going to have a monetary system based on monetary metals, you got to have silver in there too, so that the middle class and the below middle class people can afford to hold silver. They're not going to go out and buy bricks of gold. They're going to look to buy silver coins. And silver actually was a monetary metal before gold was,
for thousands of years.
Thousands of years. Well, I mean, it wasn't a monetary metal for thousands of years before gold. But going thousands of years back, silver was actually a monetary metal before gold. So, I mean, there's historical pedigree and precedence there, and you can't ignore the monetary qualities of silver. They're very similar to the qualities of gold.
And in our nation's founding documents, which we seem to ignore nowadays, they call silver money, don't they?
Yes, absolutely.
Well, transitioning to the juniors, and let's talk about silver juniors. I have a question about a recommendation that you gave a year ago for silver junior, Discovery Metals. You recommended last summer at about 20 cents US. This stock has just been rip-roaring as of recent, hitting, as we speak, 92 cents US. So that's about a 4.5-time gain for you and your subscribers. So when you have a stock go like this, it goes up 350%. At what point do you say, I'm going to take some off the table of my investment or possibly all of it? Like, how do you make an exit strategy decision at this point?
Well, that's a great question. I've addressed that. It's basically capital management and position management in my Mining Stock Journal newsletter. I've addressed it in the past, and I've had a lot of new subscribers lately, and several have asked me about that over the last week, specifically with reference to stocks like Discovery Metals or GR Silver. That has had Eli Gold Royalty has had a huge gain from when I first recommended it. And, I'm going to sort of answer it partially, but I literally just wrote up my view on it and the way that I think is a good way to look at it for my subscribers in the next issue, which is next Thursday. But the simple answer to that is if you bought a decent sized position for yourself. And again, all of this, it's an art, not a science. And there's a lot of variables involved. And one of the variables is, your preference for risk and your tolerance for risk. If you bought Discovery Metals at 20 cents, did you just buy a little, toehold position and it started going higher and you said, I'll wait and see if it pulls back, and it didn't. And, all of a sudden you've got a 400% gain on it. What do you do with it? If it's just a small position, I'd probably hold it, because the way that I would look at Discovery Metals is it's got essentially right now about a $210 million market cap, US dollars. Everything that I'll talk about will be in US dollars as opposed to Canadian dollars. If they have what they think they do, with their silver project in Mexico, this, Discovery Metals could, in the next year or 18 months, it could turn into a $500 million market cap company. So you got another double in it, right? But, if you bought a large position in it down at 20 cents and all of a sudden you're sitting on 400% gain, I think you got to sell at least a third of it, take the cash off the table. If you sell a third of it, you've got the rest essentially for free, right? For me, if it's any stock, it doesn't matter if it's a mining stock or a tech stock or, a company that produces widgets. If you got a 400% gain on a decent sized position, you got to sell at least a third and maybe even a half, because, markets don't go straight up, and Discovery Metals, has gone somewhat straight up, but it's not going to keep going straight up. You're going to have sector volatility and you'll have ups and downs that are specific to the company in terms of expectations versus, especially for like drill results. Cordero, that's the name of their project. I was trying to think of it. I've been familiar with that one since Lavon Resources, before Discovery merged with Lavon and took over the Cordero project. But at any rate, now at 90 cents, you've got a certain level of expectations about the drill results going forward. And if those drill results, and it's very possible, they could fall short of expectations, the next couple drill holes or series of news releases on the current drill program. And if that happens, you're going to see a sell-off in the stock. Now, a series of drill results that don't meet expectations doesn't mean the project's not going to do what we think it'll do or what management thinks it'll do. It just means they were drilling in the wrong place for what they were trying to get accomplished with those specific holes. But it also gives the management more information for the next drill program or the next set of holes that they're going to drill. You see what I'm saying? So, but at 90 cents, you got a certain level of expectations built in. Say the next 3 months, the results don't meet the expectations, the stock sells off to 70 cents. You'll be happy that you sold stock at 90 cents, and then you can take some cash. And if you still like the story and you still think it could go from a $200 million market cap company to a $500 million market cap company, you add some at 70 cents. So that's kind of gist of managing your capital and managing positions and managing the overall risk of your holdings.
We'll be right back after this word from our sponsor. Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to OsinoResources.com. That's OsinoResources.com. On a relative basis within the junior mining sector, when you compare a Discovery Metals or a different discovery exploration story like Great Bear, which is reaching just astronomical valuations relative to 2 years ago, when you could take stories like these and you compare them to some of the mid-cap producers, don't you think a safer investment at this point might be the mid-cap producers?
Again, it's kind of... I know what you're saying there. I mean, certainly with Great Bear, there's still, a lot of risk there and a lot of de-risking that has to go on. And there's no guarantee that it's going to end up being an operating mine. I think Great Bear probably will be, but nothing's 100% certain until it actually happens in this industry. I mean, there's companies like Treasury Metals that I've followed for a long time, and it's actually, I was pounding the table on it over the last 3 or 4 months. I was pounding the table on it below 20 cents, and now yesterday it closed at 40 cents. And, for a company that's basically, a hop, skip, and a jump away from making a construction decision, I mean, it's substantially de-risked, like significantly more de-risked than Great Bear. I mean, they've basically almost have all their permits in place. They'll be able to get construction financing, and they still preface everything they say with, assuming we make a decision to proceed with construction. So, and that tells you, I mean, they're saying that because there's always still some risks that could come in out of left field that undermine the ability to take the company to the next step. And I mean, I'm probably 99% certain that won't happen with Great Bear, but that a lot of people might say that's optimistic. So, I mean, Great Bear, I forgot what the market cap is right off the top of my head. And you're right. I was looking at it just the other day. I'm like, wow, this market cap's getting pretty high. But it's basically telling you the market has looked at what they've drilled out already, and it's high quality, it's high grade. It looks like there's going to be a lot of it, although you don't know for sure until they start doing a lot more infill drilling. But it looks like it's going to be a monster project. It's kind of the same thing with Silvercrest Metals. It's going to be a monster silver project. Silvercrest Metals, the market cap, I think, hit $1 billion this past week. And so, if you want to compare that to kind of a mid-cap producer, you got to look at each individual situation. I mean, you could have like mid-cap producers or, smaller mid-cap producers that are, producing, 80, 100,000 ounces of gold a year, and maybe they have a market cap that's $200 or $300 million. But that may be all they have is that one property, so their upside is going to be correlated with the upward movement in the price of gold. So, I guess it's not formulaic as to whether you would want to say, okay, well, Great Bear or Silvercrest, they have these gigantic market caps, and I can just buy a smaller cap producing company and get better performance. You're certainly going to significantly reduce the risk profile of your investment if you swap from Great Bear to a mid cap producer, but you might be leaving a lot of upside on the table with something like Great Bear or Silvercrest because they're both sitting on projects that just could be absolute monsters.
And if I'm taking big swings at potential returns, though, I do like a little less risk, and that's where those near-term producers come into play. One stock that's been performing well is Pure Gold there.
That's another one I was pounding the table on 3 months ago in my newsletter.
So what are you up to, 300% now? On that one?
Something like that. The thing about pure gold is that I think their property has the potential for a lot more resource upside than the market had been giving them credit for. I think the market over the last 6 weeks or so has started to price in the potential for resource upside. But again, I mean, the thing about pure gold's resource is it's very high grade, and I actually think pure gold will probably be acquired before it ever starts mining, but we'll see. And treasury metals and pure gold are, to me, they're very similar because they're both getting very close to making a construction decision. Now, treasury metals purchased that first mining property, Goldland, and initially, I think a lot of people in the market, or at least a lot of my subscribers that email, they're like, "Geez, it seems like Treasury Metals is issuing a lot of shares and is giving up a lot of value for this property." The thing about the property is, and I was on the webcast where they got management got on there with some guys from First Mining, and they talked about it, and some of the people involved with this think that ultimately there could be as much as a 10 million ounce resource there. Now, I think that's aggressive, but who knows? But I mean, even if you say ultimately between the Goliath property and the Goldlum property, there's 5 million mineable ounces. I mean, that's a big gold mine by today's standards. There's been very few in the last 20 years. There's been very few 5 million ounce gold discoveries. So again, there's obviously plenty of exploration risk as to whether or not they can ever prove up a resource of that size. But at least the early indications are that there could be something significant there. So ultimately, I think Treasury Metals has a lot more upside from here. And I think that Goldland acquisition was a really good acquisition for them to make. And again, it's like pure gold. I think at some point you're going to see Treasury probably get acquired by a real much larger cap company that already has production and will go in there and put in the mine.
Before you go, Dave, could you introduce possibly a mining stock pick that you've already given your subscribers a chance to pick up in the market if they want?
Sure. And I had a lot of great ideas earlier this year, but like Discovery Metals, a lot of these stocks have already tripled, quadrupled. The performance of my fund, the equity portfolio side of my fund was, we were up a little bit on an unaudited basis at this point, over 100% for the second quarter, and a lot of it was, and I invest either personally or in my fund in almost all of the ideas that I present. I mean, that's part of why I started the Mining Stock Journal, was because it would force me to actually do a lot more research and look at a lot more ideas for my fund. So. But now there's a company, and I typically, as you know, Bill, I try to keep my best ideas proprietary for my subscribers. But if I've been following a company and recommending a company long enough, I don't mind sharing it with on podcasts. And there's a company called Rugby Mining. It's RUG.V on the Venture Exchange, and RBMNF on the, again, I don't know if it's OTC bulletin board or pink sheets at this point, but it doesn't matter. I mean, you can trade it. It's in, the 5-letter symbol's not real liquid, but it'll get more liquid over time. So this for me, this company is really an investment in the management as much as it is in the projects that they have lined up. So the management is, and the board is basically the same people who went in and developed Exeter Resources, which was a giant copper gold porphyry project in Chile, and ultimately Goldcorp, before it got acquired by Newmont, purchased Exeter for that project. It's massive, 30 million ounce copper gold. I think it's 30 million ounces of gold equivalent, but a lot of it's copper. So now Newmont owns it. And then before that, they went in and built up Extore and sold that off. And that the Exeter was actually a spinoff from Extore. So it's that I think that the guys now running rugby, Bryce Roxborough, Yale Simpson, and their team of geologists, I think they're like extraordinary geologists, and they put a lot of their own money where their mouth is. So for instance, Bryce Roxborough right now is by far the largest holder of rugby, and every time they've needed to raise money to keep going, he's reached into his pocket. So, but they've got a project in the Philippines, and I can't remember the name of it off the top of my head. That is a potential for a large copper gold porphyry, and they've done some drilling on it. And they also have 2 gold silver projects in Colombia. And the project that's kind of on the front burner now is one of the gold silver projects in Colombia. And again, I can't remember the name of the project off the top of my head. And I literally just wrote it up for my next mining stock journal. But what they're waiting for down there is to get drill permits. And also for Colombia has been one of the more restrictive countries in terms of dealing with the virus. So right now at this point, they can't even drill even if they had the permits. But it's going to happen in the next few months. And Colombia is a very hot country right now for gold projects, copper gold projects, and gold silver projects. And I was talking with Rob Gray, he's the corporate development guy, and he was the corporate development guy with Exeter. And he said that Bryce is convinced. Bryce and Yale Simpson are both convinced that this project is a discovery waiting to happen. And when I hear those 2 guys say something like that, it pricks my ears and I get interested. Now, again, this is and I've talked with Bryce and I've talked with him about the Philippines project. So the reason why I think this is an interesting opportunity is, and again, it's highly risky. They could start drilling out all their projects and return nothing. They could be dusters. Who knows? I don't think they will be, but I mean, it's a 6-cent stock, right? So you've got a market cap of about $8 million there. And so your downside is very limited. Your upside is, 5 or 10 times potential. And that's why I like this situation. That's why I like the name. Again, if you're going to invest in this, use money that going into it, might get cut in half. So you don't want to swing for the fence with this one yet. You start to build up, as they start drilling, and if they start getting results that indicate, and again, they're not going to necessarily make a discovery on the first set of drill holes that they poke, but each drill hole that they poke, whether or not it makes a discovery, gives them more information about where to put the next drill holes. So as drill results start to flow, say over the next 6 to 9 months, assuming Colombia opens up enough to let them start drilling, that's when you start to add to your position. And it may, this stock, let's say the drill results are favorable, in the first phase of their drilling, the stock might go from 6 cents to 10 cents. But, you're going to add at 10 cents because there's a little bit less risk because it's starting to look like there may actually be something there that's worth spending money on in terms of exploring. So, this one I kind of put in the category of extremely high risk, but extremely high return. And again, at this point, it's a bet on the jockey, not the horse.
Dave, you mentioned that their OTC listing is not very liquid at this time. Do you think it's wise for a lot of these companies that want to reach U.S. investors to upgrade that OTC listing to at least the OTC QB or QX even?
Well, I mean, there's qualification standards. So if a company, there may be 2 reasons why a company stays on the pink sheets instead of gets formally listed on the OTC bulletin board. And they may not qualify for listing on the OTC bulletin board. And, that doesn't delegitimize the company's project. Or detract from the legitimacy of the project. It just means they don't have enough substance yet to qualify for listing there. And then it's also more expensive. So there's also costs involved. So you got to kind of balance out, capital management with the benefits of, moving from the pink sheets to the OTC bulletin board. I was just trying to look on here to see if But I will say that companies that are still on the pink sheets but can qualify and can afford the OTC bulletin board listing should definitely upgrade their listing, because, to the extent that the OTC bulletin board has listing standards, and there's 3 different levels and each level has higher listing standards, it's just another check and balance that, hey, this company is legitimate. So if the company can qualify for the listing and can afford it, they should absolutely do that. And it also improves the liquidity, and improves their ability to raise capital.
If you want to find more about Dave's his mining stock journal, please head on over to investmentresearchdynamics.com, and you'll see right there at the header, you can click on the mining stock journal. Dave shared some of his picks, but those were picks that were revealed weeks or months prior to his subscribers. As always, Dave, thanks for coming on today's show and sharing your insights.
Thanks for having me on again, Bill.